Here I am. I got the squeaky chair. This is Frank Peters. We're in San Juan, Puerto Rico for Labor Day weekend. And where are you spending your weekend? Anyway, we've got you beat. And here I'm with a couple of my great friends, Mick Williams from Boston Harbor Angels.
Hi, Frank.
John May from Washington, D.C.
Washington, D.C. And the last time we met, it was in Istanbul.
Oh, Istanbul. Well, Cheapers Crow, that's right. And then you're the latest Hans Severin's award winner, too. We've got to get that in.
Thank you.
That year goes by awfully quickly.
It does.
Yes. So we thought we'd get together tomorrow. See the squeaky chair. Tomorrow, we three join a few others, and we are judging. How would you describe it, Mick?
Well, it looked to me like a pretty routine business plan contest that we've all done many, many times before. And there's some very interesting companies tomorrow.
And they've been pre-vetted. What else has been done to them, do you think?
I don't know, they call it a demo day, and so I think it may be the culmination of a process of coaching and mentoring, getting them ready for outside investors.
And so all week long I've been looking in the mirror and saying, be constructive, don't be too critical, and that's how we'll play it tomorrow. So,
I think, Frank, after you've been doing this a few years, it is very easy to be critical. There's always flaws, and I think the important thing is that when you're criticizing, you need to give them information that will help them develop their plan. And then it becomes what's called constructive criticism, which I've heard no criticism is really constructive. It's all destructive.
Unless you're writing a check. John, what are your thoughts for tomorrow?
And over lunch, we were also talking about the fact that in the most fertile areas, in the most experienced areas, the 50 or 60 plans that come in are winnowed to the 5 or 6 or 8 that we interview. We only maybe select 2 to present to our angels. So there is a lot of rich dialogue and opportunity for constructive help to the 5 or 6 that we don't choose. And no one in any economy should feel like they're being picked on. That's true in any ecosystem.
Sure. And perhaps, I see it in my neighborhood, you do too, right? Companies tomorrow, they'll get some feedback, they'll go away, digest it. Some of them will come back. But John, you mentioned sitting around the pool today, and we did. It's all part of getting our head in the right place for tomorrow. We sat around the pool, beautiful, breezy, tropical, probably 85 degrees. I thought we'd recapture some of the things we talked about today. John, somebody started this whole subject of super angel funds. They're popular, I guess Silicon Valley, it's sprinkled into Los Angeles too. A lot of interest, a lot of buzz on the super angel funds.
Yeah, it's sort of almost been captured recently by the press as a new phenomenon, but of course it's been going on for a long time. It's just adding the word fund has been the nuance that we've noticed recently. Historically, those that don't do the $25,000 or $50,000 check into startups, those that do $250,000 or $1 million have always been there. We've always called them super angels, whether they like being called that or not. But over the last 6 months, they've realized that they fill a particularly important niche in the venture ecosystem, and that if they organize more money, $5 million to $10 million, they can have a lasting influence on their community.
Going to start one in Boston?
Well, we have the same phenomenon going on all the time. There's people that have more money to invest, and they're looking for different type of deals than the smaller angels who are looking for the $25,000 to $50,000 investment. There are people in our group that would like to spend as much as $1 million on a deal, although that's not the deal we see. So that deal's a later stage deal. But I'd like to say all my angels are super.
I suppose this is good for angel investing in general. It puts it on the front page of the paper.
Well, I think the most important thing is to emphasize to entrepreneurs that the whole continuum is trying to be serviced, whether it be friends and family, whether it be the structured angel groups that the Angel Capital Association has championed, organizing 30, 40, 50 angels together who might do $250,000 or $500,000 together, pooled. But now we're finding with the VCs going upstream, this super angel fund concept, $10 million, $20 million, led by a cashed out entrepreneur, an angel, as opposed to a staff or a general partner of a fund. it's an interesting filling of the void that existed.
Mm-hmm, mm-hmm, mm-hmm. A lot of the companies maybe that we see, they only need a little bit of money these days. It gets overused, but it doesn't take a lot of money to start a software company these days. All the other expenses stay the same, trying to take it to market, build your brand, all of those things. So anyway, super angel funds are great, generating a little buzz, a little summertime buzz.
Well, the buzz has also been the spin that some of them put on it vis-a-vis the traditional venture capital community, where they're trying to almost act like they don't need those big boy VCs, those bad VCs. They're trying to assert themselves as maybe an alternative for entrepreneurs. We'll see how that plays out over time.
The VCs have been accused of throwing too much money at the companies too quickly. They have to get it out. And the logistics of that, their investors demand that. I'm assuming that's the reason that they do it. They got to get the money out. Nobody wants to see.
Average round last year by institutional VCs was something like $8 million. If you only need 500,000, you're swamped.
Here, take 8. It can cause problems.
Bill Reichert at Garage Venture says venture capital often straps a rocket onto a small company, and I think the analogy is fitting. That can be dangerous.
Well, and the nice thing about angels are, because we're using our own money, we don't want to put the least amount out for the biggest bang for the buck. We don't have an incentive to throw a lot of our money at the same problem.
Well, because it's our money, not investors. John, you mentioned you got a new board member on ACA.
Yeah, it turns out, and in fact, I think I misspoke. It's probably the ACEF, Angel Capital Education Foundation, has Rob Wiltbank, Professor Rob Wiltbank at Wilmette University in, I think, Portland, Oregon. In Oregon.
State of Oregon.
We realize that we're doing so much now in the area of research and education, we should get some expertise. And, he did that study that was released in 2007 about exits by angels. So we're really glad to have Rob on board.
Yeah.
Well, his legendary study is getting a little old now. We'll have to see what the next study will show.
Well, and we were also talking about that at lunch, because we let our hair down a little bit about the good, the bad, and the ugly at lunch.
And I guess you're implying, Mick, that in the past few years there haven't been a lot of exits. So,
well, I didn't imply that.
You didn't imply it.
But he could have said that there have been fewer positive exits.
Fewer positive. Oh, there we go. Qualifying. Now I've got to clarify. I've got positive news. Is in Los Angeles. Everybody's got their chest stuck way out and bragging. 2 acquisitions this summer. One just this past week, $100 million exit, a Tech Coast Angel deal. Earlier in the summer, a $40 million exit. Then 2 IPOs. One, of course, the Green Dot deal, 110x returns for the investors. Now, I'm not in that deal. That was 9 years ago when that deal first got funded. I wasn't part of the group at that time, so I missed that boat. But so there are a lot of guys in Los Angeles thinking that everything's working just fine.
Sounds like the IPOs are back there as well.
Yeah.
What do you think that does, Frank, to the angel business when you get a lot of publicity on a 110x deal? Where else does that happen? There should be a flood of new investors anxious to tap into the easy money in the angel investing business. Is that right?
That's right. You do have to underscore that deal was 9 years in the making. But I've always thought that I don't know that we've seen it yet because, the month of August is quiet. But this fall, I expect, I imagine, will attract more members, and maybe valuations will try to, work their way up a little bit. All of those classic kinds of, cycle indicators. But so anyway, that's good news. I've often thought that 110x out of the Green Dot deal, a lot of those investors 9 years ago, they weren't spring chickens then. A lot of that money going to come off the table, I imagine. Huh?
Although it's really important for any community to have that, regardless of the age and stage of the investors.
Well said, John.
The community needs to know that entrepreneurs with a vision, with a dream, and patience will have backers in their community, not just banks.
And if you're an investor, these kinds of opportunities continue to manifest, and that's a lifestyle-changing investment. Hit anything bigger than 110x, John, in your portfolio?
No,
Still
the 101,
waiting.
102, but not the. But that is an unusual story because the institutional VCs who track this much more than we do with the occasional Wilt Bank study, the VCs are not very happy about the M&A market, the IPO market over the last 5 years, and the top decile is barely breaking even, returning capital in that entire industry. So it's good to hear that there's an occasional win in the angel business.
It's interesting. Right now, you're reading about all these companies have so much cash stockpiled. And the idea that at some point in time they've got to spend that money, and I'm hoping it's soon. And, of course, in a lot of my deals, we're hoping it's soon.
And we want to help them.
Exactly. But it's just amazing how much money they're amassing. They've laid off employees. They've thinned down. They've done everything to make their ships sails a lot more quickly and lightly in the water. And at some point, they've got to fuel up here, I would think.
At a recent M&A class, MBA class, I was trying to show the size of the American venture capital community, which last year only put out $18 billion after about a $25 billion a year at run rate this past 5 years. Cisco, Apple, Microsoft all have $20 to $25 billion in cash in their own treasury versus the entire U.S. venture capital community of 1,000 firms putting out $20 billion. One company, as Mick mentions, is sitting on that amount of cash.
Well, and just this past week, Hewlett-Packard authorized another stock buyback.
$10 billion.
So, the glass half empty with that is they can't think of anything better to do with the money. That's too bad. We should get their phone number, huh? Another statistic we all saw it on the paper just today, big companies pushing more of their healthcare costs onto their employees, something like 14% in the past year, when healthcare costs only rose about 3%. So anyway, they've got plenty of money, it sounds like.
Well, and the big issue, as you know, with the public policy issues we were talking about at lunch is what should the federal government, what should state governments do to encourage innovative company finance, gazelles or scalable businesses? And it's true that if you start burdening the small business with more and more of these costs, they may or may not spend money on R&D. The federal government has to step up somehow and do the right thing, but a lot of us are worried about what is the right thing.
Well, John, I remember sitting around the pool again at lunch. You spoke of some of the European models you admire. What?
Well, I mean, this gets into the whole Angel Capital Association, public policy. Boston might have a different idea than Las Vegas or Atlanta. But one of the things seems to be clear is that government money alongside private money, piggybacking, let's call it, like the London or the Scottish model.
Or Ohio.
Right. And in some state programs like Ohio, we talked at lunch about how the tax credit side, giving us more money to recycle into more deals, or side-by-side investing by government who plays a limited partner role, if and only if we pull the trigger. Both seem to be things that have worked elsewhere, but we haven't seemed to be able to get it right at the federal level in the U.S. yet.
Right. In Ohio, it's, I remember John Houston talking about like $2.5 million that has to be matched by his local angel group. They get into these deals at 50 cents on the dollar, then something like that. I don't know all the details, but that makes it very attractive for the angels.
But they are a member of the ACA and have a link at the Angel Capital Association site. If people want to go research some of these programs, that's a good source.
John, what are the unintended consequences by government getting involved with too much subsidy or the wrong type of subsidy? I've heard arguments, but I don't know what they are. It doesn't make sense to me that if you encourage, you give incentives to encourage what behavior, but I hear there are unintended consequences sometimes that people make bad bets on purpose so they can lose their money. I mean, what's going on?
Well, it is true that the old SBIC program, the Small Business Investment Company program, was a licensed program that had a lot of regulations attached to it that did seem to have some problems on the equity side. So like you say, the unintended consequences caught up with some of the good faith approaches that were tried. the states have a tax credit program, many of which have not been enforced long enough for us to have that longitudinal research to know if it's net positive. Do you get new investors? Or as Scott Shane recently put in an article, if all you're doing is rewarding people who do the same investment that they would have done otherwise, then you have less money going into deals and more money coming from the Treasury. So I don't think we should rush headlong into aggressive governmental programs. But when you start hearing what the Europeans are doing, what the Chinese are doing, it might not be bad to at least continue to research and study this.
I've heard this, and I've never verified it, but in London, or in England, your gains are not taxed on investments?
No long-term capital gains if you invest in a qualified company in ordinary shares instead of preferred stock, and you get a 25% credit on your next year's federal taxes in the UK system.
And the French have a great incentive program. They're almost suffering from too much money going into early stage. I've heard it.
Right, because they're, of course, dealing with a wealth tax, which we would prefer not to deal with as well. So.
Right, yeah. So we've made it through the summer months. It's often a quiet season in angel investing. We're coming back September. The next quiet season is the holidays. It's a short period for an entrepreneur to approach an angel group, make their case, go through due diligence, and get their deal closed. What advice do you have for entrepreneurs that are thinking about approaching a local angel group right now?
What's your process, Mick, in terms of how do they get into the funnel and how do you give them feedback?
Well, we have everybody has to apply online, and there's no limits, there's no application fee, so anybody can apply. And it's a fairly simple process. You can put everything from your executive summary or videos or whatever you want onto AngelSoft, one of your sponsors, your fine sponsors, Frank. Yeah. And therefore, then we see those companies, and there's an opportunity for all of our members to look at those companies. I can't tell you that they do. Our managing director generally will direct the ones that he likes to people that he thinks should like them. And then we have a committee system where we have the IT committee and the medical committee and the general committee, and then they vote on the ones that they do the beauty contest. So people want to buy my vote, which they are perfectly capable of doing, but it's for sale. But it doesn't do any good. That's the only thing.
So it's a filtering, a bubble up process, kind of, huh? Cream rises to the top. How about in your neighborhood?
The interesting thing about early stage companies is that they should understand, and the ecosystem should not encourage them, that this is easy money, or that there's an angel or a VC around the corner. Very, very few companies are scalable and have enough upside to be what I call an investable company. So the first thing I do is encourage them to look at every other source of capital, their own money, the SBIR and the research dollars, friends and family. They have to show good faith that they've bootstrapped. And the recent issue of Inc. magazine is the annual 500 fastest growing company issue. It's very interesting for entrepreneurs to look at what are the types of companies, where are they located, how have they been funded, how big are they after so many years, to give an idea of what it takes. And it was interesting this time they gave a statistic that said 23% of those on the Inc. 500 had gotten some angel financing, which means on the other side, 75% bootstrapped, friends and family, use their own pension fund, their own credit cards. So I think it's important, first thing to do is to realize that the angels are not the only approach, they're just one approach.
I think David Friend from Carbonite told me, I think they're number 9 on the Inc.
Yeah, they were in the top 10. Yep.
Yeah. Mm-hmm. Yep. John, your point there about the scalability and the size and the certain companies don't fit that parameters. We look at everything. So we've funded everything from a self-cleaning cat litter box to a dessert restaurant. So we're not always just looking for the huge scalable companies. We're looking for companies that we like the people, we get excited about the opportunity, and we're not always just gazing at the stars.
Although the way I would put it is, when I say an investable company, it means that there's enough room for an investor to make a return, a risk-adjusted return, along with the entrepreneur. So you're right, it doesn't matter whether it's kitty litter. It doesn't matter whether it's kitty litter.
Lose sight of that, Mick?
Yeah.
Kitty litter or Google. It matters whether it's a lifestyle business or whether it's got enough room for investors to partner.
Investor grade, I often call that, John. Huh? Yeah. I mentioned that I was on a startup weekend in San Diego just a couple of weekends ago. Had a great time. It was thrilling to see these young people come together in the course of a weekend, sit down, put together concepts, build them out, write code, make presentations Sunday night. I was surprised at how many of them had emphasis on some kind of, what do we call it, social enterprise, some kind of for the greater good of mankind. You seeing any trends like that, Nick?
Well, we saw the green coming hard and fast, and that's kind of died out. I think our investors will certainly look at those things, and what we do altruistically, we all have our pet projects and charities. But again, I think when we're at the angel investing, we're looking at the pure business opportunities, and if there's good stuff going on, then that's fine. But that's not what we'd look at. That wouldn't make us more likely to invest. Feel-good investments are feel-good investments, and if they're in the matter of healthcare and things like that, there's a lot of opportunities that where you really feel good about your investment. And I think the idea that everything's about returns, if you have that attitude, it really won't serve you well in the angel business. You have to be able to really feel good about helping people, moving them forward in their lives, mentoring them, and making a difference and changing people's lives, which I think is so important for us who have been successful perhaps in our past and able to pass on something to the people in the future, and no better way than through mentoring and championing deals, which is one of the things I like to harp on.
I often think on the social entrepreneur side, a frothy market would float more of those boats, right? But we don't have that. Not right now, not in this economy. Have you noticed any changes, John, speaking of the economy, what your local angel investors are looking for in a deal? I mean, the supply and demand. Lots of entrepreneurs, the economy has reduced the amount of capital available. How's that affecting your average entrepreneur?
Well, the way it's affecting the entrepreneurs in our world is that we've been around the current group, active angel investors, since 2003. We have a number of portfolio companies. We have a number of companies that have received at least one round of finance. What they're finding is taking longer, costing more, and exits are pushed off. So what they're coming back to the angels for is sustenance, and what Sequoia talked about, cash is king, and having a sustainable business model.
Yeah, right.
So that's what I'm finding is that what the group is looking for is feedback on the existing portfolio and how to support the children as much as it is looking at new things. And the segue to the new things is, if it's new things that take tens of millions of dollars that are not in our pocket from venture capitalists in a down market for venture capitalists, our guys might look at smaller transactions that can get to cash flow faster than they would the traditional home run, because the exits are not there.
That's interesting. A number of our investors were at the Angel Capital Association meeting and heard Basil Peters, or have read his book, or listened to what he has to say. And it certainly makes a lot of sense, particularly these cash flush companies. A $30 million decision can be made at a fairly low level, $40 million decision. The exits, when you go in with and you have 3 or 4 or 5 as your post money valuation, it's really hard to get the valuation. But if you have a $500,000 in, it's a lot easier to get a reasonable multiple on a deal. So I know our guys are looking more and more at deals. We don't want to go to VCs, that we'd like to get profitability without the VCs. Then the VCs can maybe come in. But we're trying to see companies that can get profitable without the VCs, so we don't take the big hit, which we have taken, believe it or not, a few substantial hits.
And that's a trend all around the United States. I think we're finding when we talk to people about syndicating deals outside our region or at the board meetings of the Angel Capital Association. And I think it's a trend there too, right, in Southern California?
Lower valuations.
And looking for deals that may not need tens of millions of dollars to get to an exit.
Right. We don't do well, that means dilution for us and longer time to exit, loss of control. Yeah, there are a few positive things there, yeah. Well, let's bring it all back to here we are in Puerto Rico. And Mick, you and I were here just last December, so they like what you said. You were great with the press last time. What did you say?
Gee, I don't know. I always have an opinion. In fact, I have a lot of opinions even when I'm wrong. But no, I think this has been they're working hard to develop the entrepreneurial model here. And when I was here, I guess I was here before you and I were here, and they were really trying to recruit somebody to start an angel group and to recruit people to do it. And I was not effective in getting that guy to raise his hand or step forward, but I said we'd be happy to help him, and then come to our meetings at Babson College. And so we're anxious to help, and I think every time that we show up, it helps them a little bit more. This is a tough economy here, too.
And they have been doing some things right. I actually was here a couple months ago and did a Power of Angel Investing seminar,
that's right,
which was good to get them in the room, spend a whole day together. One of the better benefits I found was that they were bonding and talking to each other across the table and doing the case studies together as if, what if that was a company down the street? How will they react when they do form a group? So I think they're doing a lot of the pieces of this puzzle right.
Like so many things, it's a game of inches. Huh? Yeah, that's football season talk. Well, we'll wrap it up right here. Thanks for spending time with Mick Williams and John May and myself. I'm Frank Peters. And like Mick implied, let's say thank you to the sponsors. That's angelsoft.net and to Stradling, Yonka, Carlson, and Routh, a law firm in Southern California. Please visit them at sycr.com. And we'll be back next week. See you then.